It's a killer strategy on its own. But remember, without solid risk management, position sizing, and reward ratios, you won't make consistent gains. I'm dead serious about that. Stick around till the end. What's up everyone? This is Immortal Trader channel. Welcome to your channel. If you're here for free technical analysis lessons, let me lay down the basics. Dow Theory has a few core rules. Grab a pen and write these down. First rule. Markets have three trends. Each trend breaks into three phases. An uptrend or downtrend always keeps going until proven, otherwise with a reversal signal. So, an uptrend persists unless contradicted. That's huge, because it lets you capture risk-reward ratios of 1 to 10, 1 to 15, even up to 1 to 30, or more. Pay close attention to that. Also, volume must confirm the trend. Volume has to back it up. What do I mean by markets having three phases? Let's look at the monthly chart. We have got a primary trend, the big picture move like a major uptrend. Charles Dow, the guy who created this theory, didn't even consider time frame below the weekly. He traded on yearly or monthly charts. Calling anything shorter is pure noise. I've adapted it for lower time frames. In Dow Theory, the market moves in trends, which can be identified by a series of peaks and troughs. Here we have a start with an uptrend. Notice how each new peak is higher than the previous one. And each trough is also higher. This is called a higher high and higher low. It shows that buyers are in control, pushing the markets upward. But eventually the trend changes. The market fails to create a new higher high, and instead we see a lower high followed by a lower low. This marks the beginning of a downtrend, where sellers gain control. In simple terms, uptrend means higher highs and higher lows, and downtrend equals to lower high and lower lows. Traders use these patterns to align with the main direction of the market. Remember, never fight the trend. Always trade with it. Make sure your charts are on log scale. Guys, why? Switch to log now, and you will see the full range better. Log gives earlier entries, earlier breaks, everything signals sooner. Right click on the price scale and enable logarithmic. Okay, that's the three trends, each with three phases. Whether it's crypto, stocks, or even forex, the markets always repeat the same pattern. Accumulation Markup Distribution. If you learn to recognize these phases, you will stop buying the tops and selling the bottoms like most beginners do. And instead, you will start trading like professionals. Let's dive in. 1. Accumulation phase. Accumulation is the first phase, and it usually comes after a sharp crash or long downtrend. Think back to 2022, when Bitcoin dumped from $69,000 all the way down to around $15,000. Everyone thought crypto was dead. Headlines were screaming, another exchange collapses. Crypto is banned in some countries. During this stage, beginners panic sell at huge losses. Meanwhile, professionals and smart money are quietly buying, but slowly, so they don't move the price too early. Key signs of accumulation. Price moves sideways in a big rectangle or box. Volume starts fading lower and lower because sellers are exhausted. Sentiment is extremely negative. When the market finally breaks out of the box with a strong volume, that's when accumulation is over. 2. Markup phase. This is when the trend really takes off. Think of 2023 to 2024. Bitcoin goes from $15,000 to $30,000, then $40,000, and eventually over $60,000. At first, only the smart traders are in, but once the breakout is clear, the crowd starts piling in. Those who panic sold at the bottom are now buying back higher, because they are afraid of missing out. The markup phase is defined by higher highs and higher lows, strong breakouts above resistance, volume picking up again, especially during green candles, increasing media coverage, suddenly crypto is back. This is the phase where trends look unstoppable and everyone feels like a genius just for buying. 3. Distribution phase. Finally, after a strong uptrend, the distribution phase begins. This is where professionals who bought during accumulations are quietly unloading their positions, but carefully, so they don't crash the price instantly. Think of early 2021 at $60,000 BTC, or early 2024 around 70,000. What was happening? Every news outlet was hyping Bitcoin. Institutions announced crypto partnerships. Everyone's cousin suddenly wanted to buy Ethereum at $4,000. That's distribution. The market moves sideways in a big rectangle again, but this time with volume slowly drying up. Price isn't making new highs anymore, it's stalling. Then once demand is fully absorbed, the box breaks downward, and a new markdown cycle begins. Distribution is usually faster than accumulation, because sellers don't want to lose their profits, they rush to exit. So, here's the key takeaway. The market is always repeating this cycle. Accumulation, quiet buying. Markup, trend takes off. Distribution, start money exits. Then it all starts again. This happens in every time frame, from the weekly chart down to even a 5-minute chart. The smaller the time frame, the less reliable, but the pattern is always there. Here are some pro tips to help you trade smarter with these phases. 1. Volume is everything. Fading volume in a box means a breakout is coming. 2. News is opposite. Bad news often comes at the bottoms. Good news often comes at tops. 3. Don't chase, wait. Pros buy low in accumulation, sell high in distribution. 4. Manage risk. Always use stop losses because no strategy works 100%. If you master recognizing these phases, you will be ahead of 90% of traders out there. Okay, now that you understand the 3 phases, let's talk about how to actually trade them. Accumulation trading. Most beginners try to guess the exact bottom. That's almost impossible. Instead, wait for a confirmation, a breakout above the range with strong volume. That's your entry signal. Place your stop loss just below the accumulation box. Because if price falls back, it means accumulation isn't finished yet. Target the next major resistance level. Markup trading. During markup, don't overthink. It's all about riding the trend. The best strategy here is trend following. Identify higher highs and higher lows. Every time price breaks above a previous high, you can enter. Stop goes just under the most recent higher lows. Use trailing stops to lock in profits as the trend continues. Distribution trading. This is the trickiest phase because it looks like price is just consolidating before another pump. But if you recognize fading volume and repeated failures to make new highs, it's warning. Here you can 1. Take profits from your long positions. 2. Prepare for shorts once the distribution box breaks down. For shorts, enter after breakdown. Stop above the box and target the next key support zone. Share your results in the comments. I love to see them. Got questions? Drop them below and I will answer. Smash that like button, subscribe, and hit the bell so you don't miss the next video. Until out next profitable trade, stay sharp. Goodbye.